Hello, everyone. My name is Sergi Lanau, and I'm the Director of EM Strategy at Oxford Economics. Today, I want to tell you about our preferred asset in emerging markets, and this happens to be local currency bonds. Why do we like them? It is both for purely macroeconomic reasons and also from the perspective of term premia and how these term premia have behaved historically. We think local bonds will do well because EM disinflation is clearly on track. EM central banks will be able to cut interest rates and quite a bit in the forthcoming period. On the one hand, bottom-up analysis from our economists shows that inflation will be, in most countries, lower than consensus expects. Most people already believe that disinflation will happen. Our country-by-country work shows that it will be faster than most people expect. On the other hand, we also run models across countries that involve a lot less judgment than bottom-up forecasts. These models also say inflation will fall, and in fact, in most cases say that inflation could be even lower than our economists are forecasting and could well fall below the inflation targets of many central banks. Separately, we've also looked at the risk that emerging markets have lost policy credibility in recent years and that it will not be possible to cut interest rates even if inflation falls. The results of this analysis are reassuring. We find that in almost all countries, nothing has happened that dented central bank credibility. It's only in the very risky frontier markets that there is a possible issue with policy credibility. For all the countries that most investors have in their portfolios, this is not a problem. And it reinforces our view that local currency bonds are a good asset at the moment. Finally, on term premium, we find that they are mostly high by historical standards and disconnected from inflation fundamentals, which we believe are very good. We think that the best investors can do is targeting high, but not the highest term premium to profit from EM disinflation. We've backtested this strategy and it works in most periods. If you avoid the highest term premium, which usually are a signal of idiosyncratic problems, you tend to do well, and in the current context, we believe the macro also supports the idea of going for high term premium. This is all for today. Thank you very much for listening to us.